Hi. Uh, in the previous class, we discussed few problems and solutions of decision making, and also the ideas behind the decision making process using the cost and management accounting data. Just for a small recap, if you remember, we discussed in the concepts of marginal costing that uh, for a company, the total cost we can segregate into two parts. One is the variable cost, second one is the fixed cost, right? There is of course, there is another category which is mix of those, which is called semi-variable cost, right, which is partly fixed, partly variable. But broadly, almost all the costs we can divide into two categories. One is the variable cost, other one is the fixed cost. Now, the behavior of this variable cost and the fixed cost, it is a little different. So, the variable costs, they usually what happens, they change with the change in level of production, right. But fixed cost, the total fixed cost does not change with the change in level of production within a given time range and within a given production range. In the long run, of course, all fixed costs becomes variable, fine. The variable cost, the total variable cost, though it changes with the change in the level of production, but the variable cost per unit, that remains fixed, right. And total fixed cost, though remains same within a given production range and time frame, but the fixed cost per unit changes when the level of production changes. So, if the level of production increases, the fixed cost per unit decreases, and vice versa. Now, this characteristics the companies use for many decision making purposes. So, earlier we discussed few cases where the special export orders where the companies received, and they need to take a decision that whether the export order need to be accepted or not, right. So, this kind of decisions, make or buy decisions, this kind of decisions the companies take by following the this marginal costing techniques, right. Marginal costing is nothing but a kind of variable costing technique. Marginal cost means the unit cost which the company incurs for production of one additional unit. That means basically it is a variable cost. Now, today we will discuss few more problems and see its solutions, right, in today's class, and I would request you to practice along with me. Now, first one for today, right, the factory produces 24,000 units. The cost sheet gives the following information: direct material rupees 1,20,000, direct wages 84,000, variable overheads 48,000, semi-variable overheads 28,000. As I said earlier, semi-variable overheads are those which are partly fixed, partly variable in nature, right. Fixed overheads rupees 80,000, total cost rupees 3,60,000. The product is sold at rupees 20 per unit. The management proposes to increase the production by 3,000 units for sale in the foreign market. It is estimated that the semi-variable overheads will increase by rupees 1,000, but the product will be sold at rupees 14 per unit in the foreign market. However, no additional capital expenditure will be incurred. The management seeks your advice as a cost accountant. What will you advise them? So, this is the question, right. So, now let us go to the solution. So, variable cost is given at 24,000 units. So, sales is 24,000 into rupees 20 per unit. So, it comes to 4,80,000, right. So, as we discussed earlier, if you remember that in short and medium term decision making, we primarily focus on the variable cost component of the total cost, because fixed cost in the short and mid term we won't be able to influence. In the short and mid term, the only cost components which we can influence are the variable costs. Like for example, I will give one example. Say suppose there is a auto component manufacturer, right, and this company manufactures the gears, right. So, now if it the factory shed, suppose if it pays a fixed amount of lease rent per year, right. Now, if its capacity is per week 10,000 units, right, and if it produces 8,000 units, the material cost will be proportional to the full capacity. So, it will be, if the total, if it produces 10,000 units per week and if its material cost is say 1 lakh rupees, and if it is currently functioning at 80% of the capacity, so material cost will be 80% of 1 lakh, that is 80,000, right. So, it will vary, but the lease rent which the company is paying for the factory shed, right, if it is say 1 crore rupees per week, that won't change, right. In the shorter run, depending upon the demand, the company can decide that whether it should operate at 70% capacity or it should go for 80% or 90%. Depending on that, it can make its production plan and accordingly it can produce the requisite units. But factory shed, once the lease has been taken, right, say on annual basis, right, the total lease rent will never change. It will remain same whether it works at 70% capacity or it works at 80% capacity or 90% capacity or even 100% capacity, fine. So, in the short run, this the cost which the company is incurring for as lease rent payment, that we can't control, right, that is beyond our control. But what we definitely control is the material cost for production. So, basically in decision making, our focus will be on this variable part, right, not on the fixed part of cost. And as if you remember, if we deduct the variable cost from the sales price, what we get is the contribution. So, in this problem also we calculated the contribution. So, contribution is computation of contribution is very important, in the sense that we have some amount of control on this contribution, right. Basically, to make profit, what we have to do is we have to earn sufficient contribution that can cover the total fixed cost, right. So, that is our objective ultimately. So, here you see the sales is 4,80,000 minus all the variable cost will come. So, direct material 1,20,000, direct wages 84,000, variable overheads 48,000. So, total variable cost, if I add this 3, I will get the total variable cost, which is 2,52,000. So, 2,52,000 is my total variable cost. The contribution is sales price minus variable cost. So, it is 2,28,000. So, variable cost per unit. So, number of units are given here, 24,000 units. So, the variable cost per unit will be 2,52,000 by 24,000, that is rupees 10.50, right. The profitability determination of 3,000 units of export. So, sales, so now we calculated the variable cost per unit, right, which is 10.50, right. And our question was what? Our question was that the management proposes to increase the production by 3,000 units, right, for sell in the foreign market. It is estimated that semi variable overheads will increase by 1,000, but the product will be sold at 14 per unit. So, in domestic market the price is 20 rupees per unit, right. It is here, it is 20 rupees per, but the company proposes to sell it at a lower price. There may be several reasons behind it. So, one major reason why companies agree to sell at a lower price is to capture the foreign market, right. So, capture a new market, sometimes the companies they derive penetration pricing, they adapt the penetration pricing to do that. They may be here also, that may be the case, but we need to see that by reducing the selling price, whether company still be able to earn a positive contribution or not, right. So, that we need to see, and we can make a decision on that basis, fine. So, now here you see it is profitability determination of 3000 units for export. So, now 3000 into 14 rupees 14, which is the price for export. So, it comes to 42,000, right. Less variable cost we already calculated here, rupees 10.50, right. 3000 into rupees 10.50, that is 31,500, right. So, if I deduct, it is 10,500 less additional semi variable cost 1,000. So, profit is 9,500. If export order is accepted, there will additional profit of 9,500, therefore, the export order should be accepted. Now, you see basically what is happening for earning a profit, the earning a profit, the company needs to cover the, if you remember, we discussed in the break even point. What is the formula for break even point? The fixed cost by contribution per unit. So, if the contribution per unit, if I divide the fixed cost divided by the by the contribution per unit, we get the break even units, right. That means, in other words, I can say the company must earn a total contribution which is equal to the fixed cost, okay, which is equal to the fixed cost. Now, this is happening, we need to check that whether this is happening here or not. Now, you see here what is happening, the fixed cost, my fixed cost is so what is my fixed cost? The fixed overhead is 80,000. So, 80,000 I need to cover, right, 80,000, and what is the contribution, I can see what is the contribution I am earning here. So, if I deduct, right, the selling price from variable cost, I will get the contribution. Now, here you see my additional sales which I am making is 42,000, and less if I deduct the variable cost and the variable part of the semi variable cost, I should get a contribution which is adequate to cover the total fixed cost. So, here it is happening. So, I am getting 9,500 additional profit after even after reducing the selling price. So, this export order should be accepted. Okay. So, this was the first problem today. We will go to the next problem now. Next problem is on Quality Product Limited, right. That has drawn up the following budget for the year 2023-2024. So, raw material is 20 lakh, labor, stores, power and other variable cost rupees 6 lakh, fixed manufacturing overheads 7 lakh, packing and variable distribution cost 4 lakh, fixed general overheads including selling 3 lakh. So, total is 40 lakh. Sales revenue at rupees 40 per unit, it is 50 lakh. The budgeted profit is coming 10 lakh, 50 lakh minus 40 lakh, that is 10 lakh. The general manager suggests to reduce the selling price by 5% and accepts and to achieve an additional volume of 50%. the more intensive manufacturing program will involve additional costs of rupees 50,000 for production in planning. It will also be necessary to open an additional sales office at the cost of rupees 1 lakh per annum. The sales manager, on the other hand, suggests to increase selling price by 10%, which is estimated will reduce sell volume by 10%. At the same time, a saving in manufacturing overheads and general overheads of rupees 50,000 and rupees 1 lakh per annum respectively is expected on this reduced volume. Which of these two proposals would you accept and why? Show complete working. So, there are two proposals, right. First proposal is reduce the selling price by 5%, right, and because of this he is expecting an additional volume of 50%, right, and it will also require additional 50,000 for the manufacturing process, right, and it will also require to open an office, right, which will incur a cost of 1 lakh per annum, right. This is first proposal. The second proposal is increasing the selling price, right. First one is reducing the selling price and second one is increasing the selling price by 10%, and it will reduce the sales volume by the 10%. At the same time, because the production sales volume is reducing, the company will save in manufacturing overheads, right, and general overheads of rupees 50,000 and rupees 1 lakh per annum respectively, right. It is expected on reduced volume, right. Which of these two proposals would you accept and why, right. So, question is that we need to take a call that which one we should accept. Now, this is for this column is for proposal 1 and this column is for proposal 2, right. So, sales for the first proposal it is 50,000 into 95% into 150. So, 95% because it is given here in the first proposal the selling price is reducing by 5%. So, it is 95% here, right, it is 95% here, and at the same time because of the reduction of the selling price the volume will increase by 50%. So, it will be now 150%, right. So, 50 lakh into 95% into 150%, if we calculate it is coming to 71 lakh 25,000. Okay. This is for first proposal, the proposal 1. In proposal 1, the selling price is getting reduced and resultant sales volume is going to increase by 50%. So, this is the first proposal. In the second proposal, the second proposal is that to increase the selling price by 10%. So, it is adopting an aggressive selling pricing strategy which is estimated to reduce the sales volume by 10%. So, because the sales price is increasing, so this sales volume is expected to reduce, but at the same time it is going to save the cost. So, we will come to that later on. So, if it happens then 50 lakh into 110, right, 10% increase in selling price and into 90% because 10% reduction in sales volume. So, 50 lakh into 110% into 90%, it comes to 49 lakh 50,000. Okay. So, you see there is a revenue change, right. So, here you see the revenue change. In this case the total revenue is 71.25 lakhs and in this case it is getting drastically reduced 49.5 lakhs here, right. So, there is a change in, but we need to take into account the cost element also. So, you will see that whether how the cost elements are changing. Now, if you go back to the question, you see in the first case what is happening, additional costs are there, right. So, now here you see the variable and fixed costs they are given, right. And of course, as I said earlier, that variable cost changes proportionately with the level of sales, right. And also what is happening, there are the costs involved here, right, and here in the first proposal, right. These two are additional costs, 50,000 for production in planning and 1 lakh is the to open an additional sales office. Additional sales office is required because volume is increasing, right. So, variable cost 30 lakh raw material, labor, stores, etc. 9 lakh, packing and variable distribution cost 6 lakh, right. So, if I add these three, I will get the contribution, I will get the total variable cost. So, it is 45 lakh now. So, 45 lakh, if I deduct this from 71 lakh 25,000, I am getting the contribution 26 lakh 25,000. So, this is the contribution I am getting, fine. From this contribution, I will deduct the fixed costs, right. So, I am getting the fixed cost here. So, it is manufacturing overhead, I am getting 7 lakh 50 and fixed general overheads, it is 4 lakh. So, my total fixed cost is 11 lakh 50,000. My profit, if I deduct 11 lakh 50 from 26 lakh 25,000, I am getting the profit here, that is 14 lakh 75,000, right. This is in case of proposal 1. So, this I can see from here, right. So, you see the here the fixed manufacturing overhead is 7 lakh, right, and I am adding 50,000. So, my it is becoming 7 lakh is becoming 7 lakh 50, right, and here the fixed general overhead is 3 lakh. With this 3 lakh, if I add 1 lakh more, right. So, my fixed general overhead it is becoming 4 lakh, right. So, you see the fixed cost, it is increasing here, right. And of course, variable cost is also increasing, right, because variable cost changes with in proportion to the sales volume. But though these costs are increasing, my sales is also increasing, right. My earlier sales was 50 lakh, now it is becoming 70 lakh 25,000. I need to see what? I need to see that my change in sales revenue, whether it is increasing at a higher pace than the increase in cost, right, that I need to check. So, after calculating the profit, I got the final profit at 14 lakh 75,000, fine. Now, so this was proposal 1. My proposal 2 was that to increase the selling price. The first proposal was to reduce the selling price and second proposal is to increase the selling price. So, second proposal is to increase the selling price by 10%, and because here in this case the product is price sensitive. So, when I am increasing the selling price, what is we are expecting is that the sale will decrease. So, it is expecting a reduced sale volume by 10%, right. But at the same time it will save in cost. So, it will save 50,000 here at manufacturing overhead and general overhead at 1 lakh. So, these two savings it is expected to happen, right. So, raw material now it is 18 lakh, labor is 5 lakh 40, packing and variable distribution cost 3 lakh 60. So, if I add it is 27 lakh, right. So, 27 lakh is my total variable cost, right. This total variable cost, if I deduct from the sales revenue, I will get the contribution, right. So, my contribution in this case is 22,50,000. Okay. We can see here that in the second option I am getting a lower contribution compared to the proposal 1. In proposal 1 my contribution is 26,25,000. In the second proposal my contribution is becoming 22,50,000. So, in second case my contribution is slightly lower than the proposal 1, right. But in this case, in second case, company is also going to save money in fixed cost, right. So, fixed costs are reducing, right. So, first reduction it is happening, that is 50,000, right, this 50,000, this is the first reduction is going to happen. So, my original fixed manufacturing overhead was here 7 lakh, right. This was my original fixed overhead. 50,000 if I adjust, my overhead is 6,50,000, right. And fixed general overhead, right, that there also company is saving 1 lakh. This was earlier 3 lakh. So, now after saving 1 lakh, it is becoming 3 lakh minus 1 lakh, so 2 lakh, right. So, both manufacturing overheads and fixed general overheads, they are getting reduced in this proposal 2. So, if I add this two, the total fixed cost I will get is rupees 8,50,000. So, this is my total fixed cost. This total fixed cost of 8,50,000, if I reduce from contribution, that is 22,50,000, if I reduce from contribution, I will get the profit, right. I am going to get the profit. So, this profit is actually 14 lakh, right. So, I am getting a, now I can see from here clearly that in proposal 2, the company is earning less profit compared to the proposal 1. So, obviously, the company, on the basis of this calculation alone, it appears that proposal 1 is more profitable, right. But in practice, when these decisions are taken, there are several qualitative factors which also needs to be taken into account, right, which also needs to be taken into account. Like for example, here we can see that in the first case, first question which may come to the mind, that whether this demand will sustain in the longer run, right. So, if it sustains in the longer run, right, then it is always better, right. So, now because when the company will create a new manufacturing facility, right, then it should not be be idle, right. If now the demand is growing, but after 1 year if the demand falls, then what the company will do with the additional facilities. So, that we need to take into account. So, these are the subjective factors. So, these needs to be taken care of while taking such decisions. For increasing production capacity, the company needs raw material, needs skilled manpower, whether the supply of the skilled labor and skilled manpower, whether they are available in abundance or not, right. If the company faces shortage in skilled manpower, then it can create lot of problem for the company in the longer run. So, these conditions need to be seen before taking the final decision, before taking the final call.